Hello, Culture Matters podcast. For introduce co-host here. Here's a quote just for this episode. A large part of being patient is using it to be prepared. Greg Abel. I'm here with the one and only Aleck Arena, Arena Securities. If you listen to the Culture Matters podcast, you know we have a series where we interview world-renowned investors, value investors, and the like on the Culture Matters podcast. All the greats from Chris Davis to Steve Baxter to Jordan Svetanovsky and Luke Winchester and Aleck Arena.
Don't forget about the most important person. That wasn't supposed to be myself, but well, let's not tell the audience who's the most important person in there.
And today we're going to talk about value investing, of course, but the recent Berkshire Hathaway 2025 annual shareholder meeting that we were both at. Aleck, what was it like being on the line?
In the line.
Yeah.
We were late this year, Jay. Wouldn't have got an A+ in our school reports, I reckon. We ended up starting in the car park. That's where the line was. It was pretty much in the Missouri River. All the lines led to the Missouri River. So like everyone was lining up at the front door, but you couldn't get anywhere close to the front door. It was insane. It was insane to see. It was the busiest Berkshire that I've been to. I don't really have words on attendance. We couldn't get a seat. We couldn't even get standing room for the first half of the day. Luckily, we got a seat in the end. And it was lucky we did get the seat because I think we would have missed history really.
Why? Why is it historical?
Because everyone will know the 2025 Berkshire AGM is the AGM that Warren Buffett stepped down as as he stepped away from Berkshire and he's handed over the reins, and he's done that in a traditional way, and he hasn't lived to his word of you'll take me out of this place kicking and screaming like I'll need to be dead carrying me out in a coffin for me to really quit on Berkshire. He didn't quit, but it was the best thing for the company going forward. That there was an organic handover.
Why was it the best thing?
It shows that he thinks Greg A was deserving. And I think it's good for the company culture. I think if Greg Abel inherited the role, it wouldn't have showed that he was deserving. It would have been like, well, he was high up at the company, and now that Warren's dead, by default he's got the role. Where this is like he's handed their reins over. Obviously, Greg can't allocate capital like Warren can. He's not Warren. He's probably just not as good if we're being honest. But I don't know, Greg, I've got nothing against you if you're listening to the podcast. But yeah, Warren's like a pretty good businessman and one of the all-time great investors. So he really understands how to allocate capital. Where Greg is an investor is probably like average. And he's a pretty good businessman. I have to give that to Greg. But he's not going to have the same capital allocation skills as Warren. And he's not going to pull as many levers as Warren could. And yeah, as Warren could. He couldn't. Sorry, I'm still adjusting to my head about the thought that Warren's stepped away from Berkshire. So yeah, Greg won't be able to pull as many levers as Warren, but they've already organically set up the business in a way where it's already set up in a defensive way where they don't need to go back to banks for funding. They don't need to go to the government. Berkshire's going to be okay. It would take a fool to blow Berkshire off from here. They would need to exhaust the massive cash pile they have. It's about $340 billion US. And then there's obviously the marketable securities portfolio. Then there's obviously the private portfolio, the private businesses they own. I was going to say private equity, but it's not really what it is. And then there's like the insurance businesses would be in that. And yeah, that's kind of Berkshire all piled into one. It's a religion of business. I don't really know. It's very hard to describe. It's a massive US conglomerate. Yeah, I don't have much else to add.
What has made Warren Buffett so competent at capital allocation?
I, like we know he's competent because you look at like his returns and all that stuff. What's made Warren so good? That's an extremely hard question. Um, he must have really, really great mental models. He must have like an iron stomach. So when can I swear?
Yeah.
Yeah, when shit hits the fan, he knows where to go and what to do and to hold steady and to buy more. And he's been able to use the insurance businesses as leverage. He's used the float to invest. He knows when to go and when not to go. It's the thing we say in Aussie rules football. You gotta know when to go and you gotta know when not to go. That's talking about running into people and getting hit or kind of running into the eye of the storm. So he knows when to go into markets and he knows exactly how much money he can allocate without getting in serious trouble if it's a really, really, really good buying opportunity. So he knows like kind of when to leverage up and use insurance float that he wouldn't have used in a normal period because the return outlook isn't that great. And then he knows in normal times just to sit back, relax, and look at some shares, do some work, and wait for him to find your intrinsic value. Um, he he started out obviously doing what I'm doing, Jay, and he really cut his teeth with that. And if you look at his track record from investing in his own private fund, I think he did 100% a year for 5 years straight.
What?
Yeah,
100% return?
for yeah, each year for 5 years straight. Well, I'm not Warren Buffett.
That's crazy.
I think he turned 2 million into 80 million.
Into how much?
Two into 80 in like
2
5 years.
million.
Yeah.
In what years frame? What time? What years is that?
I'll need to Google it.
I think this is the fifth. Well, maybe in the 50s. If 65 was when he got the mill,
Dude,
Berkshire
he
Textile.
was 22. He was 22.
He was okay, so 52. He was born in 1930, August.
Okay. Yeah. I know he was 22 at the time. He was like, and he raised $2 million around Omaha, Nebraska, and a lot of it came from his father. And his mother wasn't a big fan of that. His father really backed him. She was a bit confused because his dad was supposed to be a pretty good capital allocator. And he was very humble and thought that Warren had surpassed him in capital allocation skills at the age of 22.
Was this after that he had been mentored by Ben Graham?
Just after, yes. Just.
What relationship did they have, you think? And
Warren,
who was Benjamin Graham?
Warren and Ben. I think they had a great working relationship. I think it was cut slightly short because uh, Ben had an affair with with his personal assistant, and they kind of shut up shop there, and he then just did a bit of private investing. So Ben, from what I understand, was a lecturer at Warren's, and then Warren got a part-time job for about a year with Ben in New York, and then he went back to Omaha when they shut it down, and he loved investing and wanted to do what Ben did and use Ben Graham's principles and started up a fund. But at the start, he was I would say Warren was he would kind of do what you do, Jay. But he would search for like distressed assets or things that were heavily undervalued to price the book, or the company had more cash on the balance sheet than the shares were selling for. And he would look for like arbitrage opportunities where he could see he would make a lot of money reasonably quickly. Like when I say reasonably quickly, I'm saying like within 2 years. And
So the company was worth more than it appeared to be.
yes, yes, like even like the company had more cash.
What type of financial analysis did he
He did
know or understand?
from what I can understand, he read all the annual reports and stuff, but he would also get out there and go on businesses. And he loved businesses in middle America because a lot of people really didn't cover them, and they were also closer to him. So he knew his own backyard reasonably well. But then if the business had more cash than the shares were selling for, he would try to get that paid out to shareholders and be fairly hostile. And sometimes the business was burning cash. That's why the market was valuing the shares at that. So then he would need to like fire all the employees and extract the cash from the business. And you don't get a very good name trying to do that stuff. You don't get a nice. No one loves you if you're a hardcore activist investor, really. Your shareholders might love you because you're making money for them, but if you're firing everyone in your local town, people might start turning up at your door with pitchforks and trying to throw shit at you when you walk out of your house.
How
So
old was he when he met Charlie?
what was in his
So
30s.
29?
Yeah, it'd be around then.
So that would have been 69?
I don't have a great memory like you.
59, 59. Yeah, 59. 1959, right?
Probably. I
So if,
I would
if
need
in
to go back
19,
and check the
was it
books.
1965 when he got the Berkshire then, or 64, 5 range?
We got Berkshire by accident, but
Berkshire,
yeah,
right?
I'd assume it'd be around then.
So that would have been 5 or 6 years after he met Charlie. Charlie was an attorney.
Yep.
And
Charlie made a bit of money out of real
how
estate
much did
too.
Warren influence Charlie in the beginning around pursuing investing? Or because Charlie had a background in what he worked with he was in the military, he did the flight paths, meteorology or something to that
Yep.
effect. Didn't
Yep.
finish his undergraduate, but got into Harvard because of his
Charlie
dad or something or a
Charlie
connection.
worked out when he was doing meteorology at for what would you say? He was would you say it was the army? Like they went he was helping out the American Defense Force, I would say. He worked out that
Maybe Air Force or something,
he didn't want to kill his
Navy.
pilots. Um so yeah, he would try to work out how he could kill the pilots and then do the opposite of that, which I think is a really good mental model for business and life. If
How would you describe what a mental model is? And why did they use these to?
you could probably do a better job of that than I could, Jay. Like it's a model in your head. It's how you think about things. It can be about like a reverse discounted cash flow. So like I kind of do what Charlie did, but in my personal business. So I'll try to look at how much cash the business is going to spit out in the next few, like the business that I'm analyzing, how much cash is it going to spit out in the next few years, and then work back from there and try to come up with a valuation. I don't model it out, do the opposite because modeling's scary and you can get whatever answer you want from a discounted cash flow. And it can make you look like a genius, but you've kind of separated the valuation from reality, if you get what I mean.
Is it because each assumption has internal contradictions? So it
Yes,
almost becomes meaningless.
it does become meaningless, Jay. Yes.
And so you invert that?
Yes, I invert that. I flip it on its head. And I
I like
only
that.
look like 2 to 3 years out. And then even if you're looking 2 years out, you're making big assumptions. So then you want to discount what it's what your valuation is in 2 years' time, because you're saying if all goes well, management meet management do what they need to do. And that's not always the case. Jay, businesses have problems.
It makes me think of Heraclitus. Uh, no man steps into the same river twice. It's not the same man, it's not the same river. So like the management from a personal standpoint or psychological, the management, if they actually do achieve that 24-month goal, they're not going to be the same people.
They're going to also have experiences, and then um, their life would have changed. Obviously, they would have got older and their family situation would have changed. If they've achieved their goals, usually they'll be slightly richer if that's through stock options, compensation, or usually the one that my management teams will have is they own shares in their own business. So if they've achieved their goals, their share price has most definitely gone up because their net profit would have gone up, leading to like, uh, what would you say? The net profit's gone up, so it's led to capital appreciation in the share price because the share price now reflects the cash flows that the business is producing.
So 65, he now Warren's in control of Berkshire.
By accident, yeah.
2025, he steps down as CEO and Greg Abel takes the
Yeah.
helm.
Pretty good innings.
60 years. There's a lot to talk about in 60 years, but wasn't it but let's go back to 65. Charlie is probably 40 or 41. Warren's what, 34, 35. He's taking
Yep.
this thing over. Charlie was a lawyer who starts investing. Now he starts investing. Is it true that it's after he meets Warren? Because Warren kind of pushes him towards that way.
I thought they were investing at the same time when they met. They
Now
had,
Charlie was involved in real estate with Otis Booth
yeah,
or something of that. Maybe is it
quickly.
true that Charlie had an interest in maybe in some level of investing in his clients before Warren? Because didn't he try to do a private investment in one of his clients? My quick curiosity, I don't recall this. Like, was that after he'd met Warren? Or was it before, but
I think it
it
was
didn't
just
really
before.
work out. It wasn't really working
Yeah, I
out
think it
that
was just
great.
before.
And then he meets Warren.
I think I'm pretty sure he by the time he met Warren, he started investing in marketable securities. Like he started investing in the share market, like not hardcore, but because he didn't have that much money, mate. He made a bit. He
How
made.
familiar are you with the real estate that he was involved in? Charlie.
I'm pretty sure he made his first million out of it.
Yeah.
It was like he made a decent chunk of money, and then from there he put that money
It
into the
was
share
like
market.
development, right?
Yeah, effectively did
How well did he do in the share market, Charlie? And in what years was
a
that?
lot better than he did in real estate.
A lot better.
Yeah,
So in 1965, he was born in 1924. So 64 would be 40. Yeah, 41. He was born in 24. So in 1965, Charlie, did he have his fund? Because didn't he close his fund down at some point? He had like
look, when
37%
Charlie
return.
started, he nearly blew himself up. He was extremely concentrated, and the position wasn't going too well. And then people were questioning if he knew what he was
What does
talking about.
concentrated mean?
He had all of his eggs in one basket. I think he only owned. It was an insane amount of stocks. It was only like you could count them
I
on
love that.
less than a hand. Um, and the positions
How can that be good and how can that be bad?
I could be good because if you're right, you're going to get a really, really high rate of return because he's bet really heavily. So it's going to be a very good outcome. It can also be bad as it stuffs up your head. Um,
Hmm.
because you're that concentrated, you become fixated and worried about the positions and um, all your eggs in one basket. So you very much do want those ideas to work out. So you can feel like the world's caving in on you. If the position's going against you, and it can affect things like your family life and your marriage and all that other stuff. So he would have been extremely stressed out. Then from there, he learned about that if you're a bit more diversified, it's not the end of the world if one of your positions goes close to zero or doesn't work out for you. You can still keep living and still keep investing and still get a decent rate of return, just not as good, but also you've kind of stayed mentally fresh.
Did Charlie get his stock in Berkshire because of Wesco being acquired by Blue Chip?
From
Or did he invest before that?
from my understanding, yes, but
He had Wesco, right? He was an investor in Wesco.
my understanding, yes, I could be wrong because
Didn't Blue Chip buy Wesco?
I think you're right, Jay.
I don't remember the whole. That's why
I haven't studied the Berkshire history in like 2 years.
because they weren't business partners really. They were just like they would talk about stocks all the
Warren
time,
and
right?
Charlie.
Yeah, like how.
I was going to say something, but I probably shouldn't say it on the podcast. But it's like me and other people in
Yeah,
my
you have a
industry.
lot of friends that
Yeah,
you. That's the culture, though, isn't it? Like the
not
people
really.
talk to each other about.
No, not always.
No,
You have to, for someone to answer the phone and speak to me, they have to respect me. They think I'm a banana.
yeah,
They're not going to waste their
a
time.
banana.
Yeah. Yeah, they're not going to waste their time. So, yeah,
So they were talking for 13, more than 13 years. They were talking. Well,
yeah.
they met in 59, so 78.
The
So
conversations went like this, Jeff.
19 years.
Warren called Charlie up, and Charlie moaned and groaned and was always pessimistic. And Warren kind of pitched the idea to him and said, "Am I out of my mind?"
Wow.
And then Charlie would moan or groan. And then Warren would translate the moan or groan to how optimistic he was in the idea. If it sounded like an optimistic groan, he would be like, "Yep, sure." Charlie might even have a look at it and buy it. So I should buy the stock too.
Wow, that's
But yeah,
interesting.
you don't always need to speak that much when you're on calls with other people. You can just sit there and listen and raise the idea of what the risks are that they might not be able to see. You kind of do better research when you sit on the phone and speak to someone else, I feel. But you're having a conversation. That's what I talked about to you. Why we talked about it yesterday. You can be blind to
Hmm.
you can just, if you're looking at it from this perspective, like front on, you can be blind to the risks, or you can be blind to what's actually happening. So sometimes you just need to take a step back. But if you're living in the person's shoes, you can't. So if someone like we've had on the podcast sits there and says, "Oh, Alex, you haven't seen it from this perspective," it opens up my mind. Just like what you do with the partners that you work with. You help go, "Hey guys, there's a risk here, there's a risk here, you're doing this wrong, it's slightly off." But they haven't seen that because they're so entrenched in the business and what they're supposed to be doing.
We're Berkshire Textile Mill. They help me clarify this for the audience. It was textiles. It was bought because at first he thought it was a cigar butt in a sense. There was a little bit more to puff.
Yeah.
Meaning the book value was here, the stock price is lower. There's a little bit of value you get.
Yeah, but also it was producing a little bit of cash, so it wasn't. Yeah, and cash was clearly winding down, but he had a disagreement.
He didn't want to get the whole thing.
Yeah, he had a disagreement with the management team, and he didn't like the management team. So
Didn't the guy lie to him, and then he didn't?
yeah, so it was kind of like, "Up yours, I'm going to take you out and kick you out." Warren was just being arrogant. It was a big
I
mistake.
wonder how long that was after his dad passed. No, he might have just been off
Probably
his
understand
normal
the psychology. Yeah.
his normal kind of cadence.
If it was me, I wouldn't have done that with shareholder capital, because he actually got like a slightly worse rate of return than you could have got, just to prove a point and say, "Up yours" to the guy. Like, his rate of returns were absolutely phenomenal and brilliant, but he left a few percentage points on the table there just to kick the CEO out and have the last laugh, really. But Jay, sometimes when you look at a marketable security, it's priced like that on purpose, but the market's discounting security because the management team's no good. So they could have thought that these guys are just going to run the business when it's producing negative cash flows, and then the business is the cash balance isn't going to be as good. So that the market sometimes assumes an outcome based on the what do you say? Based on the personalities of the management team, based on the competency of the management team. And it's, in that case, it was up to one of the shareholders to be an active investor, really, and go do the hard thing and get extra buck that was in the business.
And they did this many years later with Salomon Brothers, and they took, we lose it. We can lose money, but you lose an ounce of reputation, and there'll be consequences. In closing, I'd like anyone listening where it looks like in the near future, or where we may be talking more about Berkshire, more about some shareholder meetings. So I'm really excited about that. This has been a very I wish we could go longer, honestly. I love looking back at the history, right? As Kierkegaard said, life can only be understood backwards, it must be lived forwards. What excites me most about Berkshire is like somewhere between 65 and 2025. There's so much to talk about. It's crazy. I've been studying this company for 4 years or so, and I still don't understand it, even though I feel like I understand some of the architecture but what's actually I wouldn't even call it a house, in the cathedral. I haven't seen every room and don't understand. I don't know what's in all the rooms, it feels like. So
Yeah,
I'm excited to go
the
in.
boys just went out there, stuffed around a bit, and created the sixth biggest company in America, and easily could have been the biggest company if they bought a few more tech stocks, but they stuck to their knitting, and that's what got them to become I think it's the sixth or seventh biggest company in America today, which is quite two boys from Nebraska. Just I don't know, in Australia would say something different and it wouldn't be too appropriate, but two boys in Nebraska just out there having fun, doing what they love to do, accidentally created one of the biggest companies in the world.
Cheers. And I want to read this quote again. A large part of being patient is using it to be prepared. So if you're listening to this, go use your patience, read, write, listen, speak. Aleck, thanks for coming back. I'm excited for more. Last words?
Thank you. I don't have much to add.